Okay, if everybody can hear me, if you can say yes in the chat box to the right, please type in yes. I just went to a new room. Maybe that was the issue. Can you hear me now? Are we getting sound? If you can hear me on sound, just type in the chat box to your right. Yes? Okay, perfect. That was just a bad room that we were in, so we had to abort that room. Let me bring you back into the presentation. So I'm going to start over for all of you. I apologize for that. Sometimes you get bad audio and video feeds on these webinars. So now that we're on sound and now that you can hear me, I'll start my whole spiel all over again. I want to welcome everybody to the room today. Today, what we're going to be talking about is how could the election outcome affect your investment portfolios in the stock market. My name is Mark Kennedy. For those of you who are new on the call today, I want to welcome you. You're going to learn some great stuff. For those of you who are current clients, I want to thank you for attending today as well. This is going to be some important things to learn and know about. Now, the one thing I will say is I'm not going to be contentious today on this webinar because I know that the election is very polarizing and everybody has their own opinions about their candidates or about different issues. So I'm just going to try to keep this broad-based today. I'm not going to endorse any particular candidate or really talk about any particular candidate. We're going to just talk about how the elections in the past have typically affect the market and how they could affect the market moving forward. Also, what some of the proposals are on the table from both Republicans and Democrats for next year, and depending on what party gets in, how that could affect the overall market as well. What I'm going to do is bring the slide set back. So let me go ahead and start that. Okay, so how could the election outcome affect your investment portfolios and the stock market? Let me also make sure you guys can see me here. So give me just one moment. There we are. All right. So let's go ahead and talk about quickly who we are. So as a firm, we specialize in people who are either in or nearing retirement. By the way, we're going to run about 35, 40 minutes today on the material. And then afterwards, we're going to have a Q&A session. So make sure in that chat box to the right that you also are participating in the Q&A. There's a couple more settings that I have to make a change to. So give me just one moment here, please. Okay, I think we're good to go. All right, somebody said they lost the sound again. Please let me know if we're on the feed and if we're on sound. Just type yes into the chat box real quick. I don't know why we keep losing the connection today. So can you all participate and just type yes in the chat box to your right if you can hear me and see me? Okay, great. All right, sounds like we are still on. Perfect. Okay, sorry about the technical difficulties today, everybody. So we specialize in people in or nearing retirement. So as I had mentioned before, we have 4 different components of Kennedy Wealth Management. We have a trading team, which is a $60 billion institutional team. And again, to get to those people, you have to come through somebody like us. They only deal with institutional wealth management firms like ourselves who are registered investment advisory fiduciaries. So again, we can share with you how that trading team helps our clients immensely compared to retail. Then we have an income planning team, which is made up of myself and my counterpart, Daniel. Then we have an estate planning team, which is made up of some very good attorneys that are experts in their field on some very advanced estate planning strategies. And then we also have an advanced tax team that we work with. And consequently, I had a meeting today with a CPA for lunch, and we were talking about his client that was selling a $45 million home in Montecito. There's going to be about a $20 million tax gain. And through using some of the advanced tax strategies that we have access to, that client is not going to pay anything, zero, in income tax. So that was pretty exciting. So we do have those strategies if you're looking at offloading a commercial property, or let's say you have a personal residence that has a lot of equity in it. We had a client about a year ago that wanted to list her property. She had bought it back in the mid-1960s in the Palisades for $60,000, and she had it appraised for $5 million. Wanted to sell the home, and we were able to do that last year. If she had gone through with that transaction, it could have been done as a tax-free sale. So again, talk to us about some strategy if you are offloading real estate, or let's say you have a lot of your money in one particular stock that you want to sell, then we can go ahead and do that also as a tax-free sale. So let's talk about what we're going to discuss today. So does the election really have anything to do with stock market performance? We're also going to talk about Republican or Democrat. What could the stock market do based on the political party in charge and who occupies the White House? What are some of the Republican policies that are proposed for this upcoming election year that could help or hurt the market in 2021? What are some of the Democratic policies proposed this election year that could help or hurt the market in 2021? And what has the stock market done in the past during and shortly after an election year? Again, we are going to have a Q&A after, so please make sure that you write some questions out in the comment box to your right so that we can have you participate in that question and answer session at the end. Also, please set up, for those of you who are not clients, a free 15-minute call with us. I'm going to put the offer up really quick here on the right so you can see that. So you'll see on the right here, it says free 15-minute call. Click here to schedule call. We'd like you to schedule that call with us. For those of you who are not clients, it's a no obligation 15-minute call. It's a chance for us to get to know each other, but also answer any of your questions that you may have about investing, retirement, tax strategies, income strategies, legacy planning, lifetime income, things of that sort. So please, if you're not a client, go ahead and click that, click the schedule a call button on the right. That'll take you right to my online calendar, and you can schedule directly with me. For those of you who are clients who are on the call today, please make sure you put in the chat box you'd like one of our team members to reach out to you, and we'd be happy to set a call up with you. Just a quick disclaimer, this material was provided courtesy of Kennedy Wealth Management. It contains general information to help you understand basic planning strategies and considerations. Nothing that I say should be construed as a recommendation to buy or sell any financial vehicle or investment. My goal with the presentation is to expose you to ideas and financial strategies to help you toward your financial goals. Please understand I can't make promises and guarantees. Don't think about this information today to be tax or legal advice. You always want to make sure you check with your CPA. So first of all, does the election really have anything to do with stock market performance? Well, if you're like most investors, you're already anticipating that the outcome of this year's race for the White House will have an impact on your money. So the vast majority of investors, a study recently that was done, found that 93% of those investors believe the presidential race will affect the stock market. That was a survey done by Hartford Funds, and 84% say they expect that it will impact their investment habits. Now, while 45% of the investors surveyed said they plan to make changes before the election, which is only in about 5 weeks, 62% indicated they'll likely make changes in the 12 months after November 3rd, according to the survey. Now, let's talk about historically, what is the S&P 500, top 500 companies? What has that done? Has it generally seen positive or negative performance in the past election years? Well, historically, the S&P 500 has seen positive performance in the past election years. According to Charles Schwab, the third and fourth year of a U.S. president's term, which we're in now, have generally seen better performance in the S&P than the first and second years over the 1950 to 2015 period. However, we have a little thing this year called COVID that we haven't had in the past. So that definitely is affecting the returns in the market this year. But typically a year after the election, markets usually see about a 6.5% increase. The second year of a president's term, they usually see about a 7% increase. The third year, which was last year, they see the largest increase, which you'll remember was a huge market year last year. And then the fourth year, they see a moderate increase of about 6.5%. So for reference, the average annual rate of return for the S&P has been about 10.8% over that 65-year time period. from 1950 to 2015, the US stock market has rallied more than 80% of the time during the fourth year of a presidential cycle. Now, that's not to say that it's going to do that this year, because again, we have that little thing that we have to contend with called COVID-19. But political parties don't necessarily matter. So I get a lot of people that say to me, well, Mark, I'm going to wait to make any changes until after the election. I'm not going to do anything until after the election. And so while many investors believe the US stock market performs better under Republican presidents, given the GOP's focus usually on tax cuts, deregulation, and business-friendly policies, the indices like the S&P 500 and the Dow have actually performed better under Democratic presidents. 9.7% annualized returns for Democratic presidents versus Republican presidents of an average of 6.7% returns. And this has been since 1945. So again, I'm not here to play political parties or take sides. I'm here just to give you that fact. We are going to have a Q&A after the event today. So please make sure that you are typing in the chat box to your right those questions so we can happily answer those after. Also, for those of you who are not clients today on the call, please set up a 15-minute call with us. It's just to answer any questions that you might have. It's a chance for us to get to know each other. We can answer any questions you have about the markets, investing, retirement, income strategies, legacy planning, tax strategy. You can click to schedule that call by clicking the button on the very right that you'll see here in your browser. So just click here to schedule call button for that. Also, you can go to bookacallwithmark.com, and that will take you into that booking agent as well. So Republican or Democrat, what could the stock market do based on the political party in charge and who occupies the White House? So let's talk about three scenarios. If Trump's elected, if Biden's elected, and if, let's say, there's an election, but we keep kind of the Congress the same way. So what could happen if Trump is reelected? So if Trump's reelected and Congress remains split, where we have a Democratic-controlled House and a Republican-controlled Senate. So this comes from Stephanie Link. She's the chief investment strategist and portfolio manager at Hightower, which is a wealth management firm. And here's what she said. She said, I think the market would like that. It would know who was in there. Small companies would likely rally on that news, while other sectors, including traditional energy, financials, and technology, would also be poised to do well. What wouldn't work is China, because the rhetoric on China will actually tick higher. So she feels that, in a Donald Trump presidency for a second term, that we are going to have some more contentious relations with China. So then what could happen if Biden is elected? So if Biden is elected, again, what Stephanie Link says is she feels the market will probably sell off maybe at 2 to 4%. And she says, I think that because of the tax proposals that he has. COVID-19 will make it difficult for Biden to hike taxes on companies. So even though he might want to do a proposal, the reality of that proposal going through and becoming law may not happen, especially if you have a split Congress, especially during COVID-19. So unless there's a vaccine, those levies will likely get deferred. Initially, the market may sell off, Link said, but she also said, I think, buy that dip, quite frankly, which our management team would do, because we also have tactical management on a lot of our portfolios. Infrastructure, clean energy, and healthcare services companies would be poised to do well, she said. Pharmaceutical companies and the FANG stocks like Facebook, Amazon, Apple, Netflix, and Alphabet, those could dip. And then we have a third scenario if there was a Biden win and a split Congress. So we kept Congress, the House is Democrats, the Senate is Republicans, and then Biden as a Democratic president. So Stephanie Link again goes on to say, she says, I think the market likes that the best because probably not much gets done, kind of like we have now. Therefore, I think equities will rally. So actually the market kind of likes it when things stay the same and not a lot gets done because it's more certainty. While Hartford Fund surveys found that many people believe Republican control leads to better market returns, history shows better performance tends to happen under a divided government, said Brian Krause, head of investment consulting at Hartford Funds. People just don't expect that, he said. Now let's take a look at the true value on a non-inflation adjusted return of $1 if you had invested that in the S&P 500, which, by the way, back in 1926, there was an S&P 500. The S&P as we know it today with 500 companies didn't become that type of index until 1957, but the S&P back then was called the 90 Stock Composite Index. So it was the early sister of the S&P 500. So back in 1926, if you'd invested $1 in what then was the S&P 500, and you can see that, again, that was before the big 29 crash that lasted through the mid 30s. You can see that whoever was president in those different times, so the Republicans are kind of the red, the Democrats are more the bluish green. You can see that the stock market went up pretty much in all cases. The only time the market really didn't go up and kind of flatlined was between the Johnson and Ford presidencies. With Nixon, part of that was Watergate. Part of that was also the huge energy crisis we had back in the early 1970s. And then also, if you look at Bush number 2, that market kind of sidelined because, again, of 2000, that huge market crash in tech. Then we had 9/11. Then we also got sidelined again in 2008. So for 13 years, it was actually a sideways pattern on the S&P. But typically under every other president, that market has gone up. And then if you take a look at the average return for presidential terms, the average return has been about 10.3% per year across the board with the S&P, no matter who was president. You'll see that the red is Republicans and what the markets did under those presidents, and the blue is Democrats. So U.S. stock market performance during Democratic, Republican, and mixed party controls of Congress. Again, if you take that hypothetical growth of $1, if I go back here real quick, it's amazing. And I had to do the math check myself, and I had to go into a couple of backtest search engines, in the S&P to actually run this, but it's totally correct, this article. But if you had invested $1 in 1926 in what was then the S&P 500, then that would be worth $10,000 today for every dollar you invested back in 1926. So if you had just bought and hold for all those years, you would have been a pretty wealthy person. Now, mixed control of the House and Senate means more roadblocks to either party's agenda. This leads to slower change or no change at all. Since the markets are afraid of uncertainty, the status quo might be welcome news, meaning nothing gets done. The chart on the next page shows how relatively infrequently there's a mixed Congress. In either case, it's impossible to identify any trends when zooming out and looking at the bigger picture over time, as investors should. Again, the stock market is not the economy or the White House for that matter. So if you take a look here where you see some of that darker shade of red, kind of with the lines in the center, those are mixed Congresses where, again, you have both maybe a Republican-driven Senate and a Democratic-driven House. That hasn't happened too much, but we have that now. We had that in Obama's second term, and then we had that from about mid-1980 to about the end of 85, 86. So, you can see that we haven't had that many mixed Congresses, but even during the mixed Congresses, the market has still ticked up. So here's the stats. Since 1933, the highest returning partisan control combination, so, to get the most return out of the market, has been a Democratic Senate. We have a Republican Senate now, a Republican House, and a Democratic president, where returns have averaged 13.6% per year since 1933. In 2020, again, this would require a reversal for all three. Our current mix of Republican Senate, Democratic House, and Republican president averages a 10.8% average annual return in the S&P. And again, this combination is likely if President Trump wins re-election. If Vice President Biden wins, the likely scenario is a Republican Senate, Democratic House, and then, of course, a Democratic president. This combination has not occurred since Grover Cleveland was not elected in the election of 1886. So we're in some pretty uncharted waters. Again, type your questions in the chat box to the right so that we can answer those in a Q&A at the very end of today's session. So what are some of the Republican policies that are proposed for this election year that could help or hurt the market in 2021? So this is from Business Insider. This is an article that I took some of this information from. So here's what is in the Trump campaign's second term agenda for jobs and the economy. So among Trump's stated priorities on the economy is create 10 million new jobs over 10 months, create 1 million new small businesses, reduce taxes so workers can have larger take-home pay and jobs are kept in the United States, strike new trade deals to preserve American jobs, and expand tax breaks for so-called opportunity zones, which, by the way, we've had a webinar event on before, to encourage investment into underdeveloped communities. Now, how this is all going to get done, we still don't know or have specifics on, but that's the agenda. The thing is, though, is Donald Trump has also been talking about cutting payroll tax. And if that happens, that could be a big negative. So let's talk about ending the payroll tax. That could hit 70 million voters who receive Social Security and Medicare. So Social Security is in trouble regardless of whoever's in the White House, but it's now paying out more than it's taking in. And by 2031, the nonpartisan Congressional Budget Office said this week its current surplus of 2.9 trillion is projected to be tapped out. The trustees warned in April that when the surplus is exhausted, Social Security would then be able to pay only 76% of scheduled benefits. So whatever your benefit is now, take 76% of that, and that would be your new benefit if Social Security is tapped out. Why such a rapid erosion of Social Security's finances? Payroll taxes. Tens of millions of Americans have either been furloughed or flat laid off as a result of the coronavirus pandemic. So they're not paying payroll taxes. Then if there is a further payroll tax cut or elimination, there's evidence that many older Americans, low on cash and unable to find work, they're opting to take Social Security as soon as they're eligible at age 62. So what that's doing is that's putting a lot of pressure on the system, and that could cause Social Security to go into negative territory instead of by 2031, by 2026. So meaning that you're only going to receive 76% of your check in 2026 moving forward instead of 2031. And by the way, Trump doesn't even have to do anything with the payroll tax. Just the fact that there's been over 40 million jobs this year that have been affected because of COVID could also play into that acceleration of the Social Security Department running out of funds to pay full benefits. Now, what are some of the Democratic policies proposed this election year that could help or hurt the market in 2021? So Biden's campaign website lists several national efforts to address some great challenges, as the Biden campaign calls it. So as president, Biden would mobilize American manufacturing and innovation to ensure the future is made in America as part of his manufacturing and technology strategy. That could be good for the markets. Biden would also mobilize American ingenuity to build a modern infrastructure and an equitable, clean energy future. That could maybe, get jobs in that sector. I know that the Trump administration is really high on oil and natural resources. So again, any way you look at it, I think there's going to be jobs in both, ends of that spectrum. Biden would rally talent to build a 21st century caregiving and educational workforce, which will help ease the burden of care for working parents, especially women, and then a decent wage, at least $15 an hour. Now, that could also affect businesses that have already been hit hard by COVID, because that $15 an hour mandate, that could force them to pay more out in wages that they have to pay now. That could mean that they wouldn't get the profit margins that they need in order to keep the business open. And you could see businesses maybe close because of that. So there are positives on both the Democratic agenda and on the Republican agenda. So what has the stock market done in the past, during, and shortly after an election year? So let's take a closer look at stock and bond returns during an election year versus the year after. So according to a gentleman named Dan Clifton of Strategist Research Partners, in the year after the election, historically, the market, the S&P 500, responds better to a Republican victory initially, November through February of the following year, but a Democratic victory ends up outperforming a Republican victory by about 7%. In the 12 months following the election, the S&P 500 averaged 4.8% when the incumbent won versus 2.5% if they lost. Now, again, COVID has changed all of this, so who knows what that could look like. But here's the average return subsequent to an election in green, and here's the average return during an election year, and that's in gray. And you'll see that the subsequent returns on an average after an election year typically range about 9.9% for the S&P 500, where average returns during an election year like we're in now typically average about 11.3%. I really don't see that happening before the end of this year because of COVID and what COVID has done. So again, I think this is a one-off election year because of COVID. But again, let's go back to COVID, because COVID is really what is going to keep this economy down, I think, moving forward, or the markets being more realistic in the future. I think the run-up that you saw from the March 20th lows of the market to where we were at about 3 weeks ago, that's really an unprecedented rebound in the market. And I think it happened so quickly, as I've mentioned on some of these other webinars, because people haven't fully factored in the breadth of the destruction because of COVID to small businesses. But there has been a lot of economic destruction. I mean, just go drive by any of these, shopping mall strips, or even look at, your regular malls. You can see a lot of stores probably won't be opening back up. That's lost revenue for the owner of that property that's housing those particular businesses. And, that creates vacancy loss, that creates loss of jobs. It just trickles down. So the U.S. corporate bankruptcy filings are at a 10-year high. This was as of September 9th. So U.S. corporate bankruptcies are on their way to hitting a decade-long high, underlining the economic pain inflicted by the COVID-19 pandemic and efforts to limit the disease's spread. I think until we get to a vaccine, and even if we get to a vaccine, number one, how are they going to make sure everybody gets the vaccine? Would people even take the vaccine? And how effective would the vaccine be? Again, as the director of the CDC said, we might not even see that until third quarter of next year at the earliest. So again, I know there's some pretty high hopes for the economy in a short term, but I think moving forward, we got to look at this, that we're like another year out of this thing. Total bankruptcies announced by U.S. companies so far this year stand at 470. That's the most for any comparable year to date since 2010, according to the S&P Global Market Intelligence. And again, the 2010 fallout was from 2008 and the 2009 financial and credit crisis. The Fed sees rates near zero through 2023 to boost jobs and prices. So again, if you're looking to make money at your bank right now, it's probably not going to be happening for the next several years. So that's why if you have a lot of money sitting in money market accounts or in your local bank, you need to schedule the 15-minute call with me. I was just talking to one of our strategists yesterday, our managers, and we do have strategies that have zero stocks in the strategy that we're pulling about 5% this year on return. So again, please make sure you reach out to us so that we can get that type of return without taking that kind of risk for those of you who are just sitting around in bank accounts. But the Fed, they see rates at near zero through 2023. The Fed's on hold until inflation's at 2%. That's far from where we're at now. 13 of the 17 officials in the Fed forecast rates to be on hold through 2023. The majority of young adults, this came out in Time magazine just a couple of weeks ago, the majority of young adults in the US are now living with their parents again. A majority of young Americans ages 18 to 29 are now living at least with one of their parents. That's according to a new Pew Research Center analysis of the current population survey data. This number surpassed the previous record of 48%, which was set in 1940 during the Great Depression. So again, why are people living with their parents? Well, first of all, some people have some really nice parents, but also because they can't find jobs. And it's a very difficult job market today, especially when you have all the layoffs and furloughs due to COVID-19. So again, set up that 15-minute call with us for those of you who are on the call today that might have idle cash laying around. Again, maybe you have a real estate property you want to sell and get out of, but there might be a huge capital gain. We can help you with that. Maybe you want to look at some more market strategies so you don't go down another 30% if the market tanks down again because of the economy. Again, it's a no obligation 15-minute call just click that schedule call button on the very right to set up that 15-minute call. That'll direct you to our online calendar where you'll be able to talk to me directly. And it's a chance for us to get to know each other, but also you can ask me questions about anything on that call, about investing, retirement, income strategies, legacy planning, etc. We are going to have a Q&A here very shortly. So again, type your questions in the chat box to the right. We'll have a short Q&A on that. Now, before we start to wrap up here, I just want to talk about something called Fed stress test. So what is a Fed stress test? The federal government does a stress test every year on the banks. So they test these banks to make sure that in another credit crisis, like a 2008 style event, that the banks have the capital and the reserves to meet their obligations to their clientele. So banks are graded on their ability to withstand a financial crisis. And what I want to say is we help our clients with stress tests also. So before they even become a client, we want to stress test your portfolio that you're in now, if you're not a client of ours, to find out how far down could you go in another, event like that happened in March. And, it's really a no-brainer. Every investor should have this stress test performed on their investments. And if you click that schedule call button, we can definitely do that for you. And here's what it looks like, just in a nutshell. This is the front page of the stress test. It goes into a much more depth than this, but you'll notice that this particular couple that came into us, they had $1 million in holdings. 86% of their money was in stock. Now, this couple is in their mid-60s, but 86% of their money was in stock. They had already gone down over 30% in March during, the whole COVID-19 crash in the market. You can see that on the chart at that very bottom, how far they fell in March. You can see that line down. Now, yes, of course, they had recovered since then, but again, that could easily happen again if we get back to a market that's not happy about the way the economy is going. And also, what's their maximum loss potential on that portfolio? Well, in their case, they have a 45% maximum downside based on 2008's worst case scenario for the worst 6 months of 2008. So now they could also have on the opposite end a good gain in the portfolio, but for our clients, they're mainly trying to preserve the $1 million that they have. So while the 38% upside might be nice and we might be able to get that, we want to protect our clients from the 45% decline. So I think when we ran this portfolio over on our remodel, that minus 45% went down to about a minus 12. And then that March low that they had gone down 25%, I think it was down right around minus 10%, on a remodel of the portfolio. So again, schedule a call with us. We can do this portfolio stress test for you so you know how your accounts would perform in another market decline. So just click that schedule call button to get that scheduled. So what should you do right now? If you're not a client and if your advisor has not recently performed the stress test like I just showed you on your portfolio, please contact us and we can do this for you at no charge. If you do not have a true income plan and strategy with a guaranteed income strategy in place that is not dependent on the market, you should probably also have a conversation with us. If your retirement portfolio is mostly stocks and you're over the age of 50, we need to discuss transitioning the portfolio from a risk portfolio to a preservation and distribution-based portfolio. So you can go to bookacallwithmark.com today to set up a 15-minute no obligation call to ask me questions and see if I can help you improve your strategy. Or you can also click the schedule a call button on the very right. Again, just as a reminder, if you have a property that you're selling out of that has a huge amount of capital gains, you can contact us. We can get our advanced tax team involved. Again, if you are not on the institutional side with trading, we can talk to you about the differences of that in retail. Also, we can do that stress test on your portfolio. And then our income planning team can structure an income plan for you to work in any environment. So our clients weren't calling us in March when the market hit its lows because they understand the kind of planning that we do for them. And then also we have an advanced estate planning team as well. Again, we specialize in people who are in or nearing retirement. Now, my question to all of you who are on this call who are not clients of Kennedy Wealth Management already is, what if you didn't need to worry about the stock market controlling your retirement or life savings? How would it feel to wake up without worry that you will not outlive your money? Because our clients, they don't have that worry because of the kind of planning we do. And what would you do with the extra time and money if your only worry was how to spend it? So you need a plan and a strategy for this. So again, book that 15-minute call with me to find out how we can improve, protect, and get more income out of the money you saved, especially if you're sitting idle in bank accounts that aren't really doing anything, or if you're in high-risk stuff. Let's have that conversation. Just click to schedule that 15-minute call. Again, you can also go to bookacallwithmark.com or click that schedule a call button on the very right. Here's also how to contact us. You can call or text us at 818-224-4177, 818-224-4177. You can also email us at info@kennedywealthmgmt.com. We're now going to go ahead and go into the Q&A. We have a couple of questions, and then we'll go ahead and wrap up today. So Bob asks, he said, I thought Trump had only said to defer payroll tax for a short time. Yes, you're right, Bob. But if later on down the line they decide they want to make that permanent, that could really hurt things. Even deferring it for a period of time will definitely take Social Security from having enough money till 2031 to bringing that way down in terms of the amount of years. The next one, Nate said, with the 10% early withdrawal penalty being waived this year for 401ks, IRAs, does it make sense to withdraw from a 401k if you're still employed with the company for the purpose of investing on your own and having more control of your money? So yes, you can do that. If you are not taking that as a loan and you're taking that as a straight withdrawal, you have 3 years to pay that back. You have to pay a little bit of it back over the next 3 years. So you won't get out of the tax entirely. But yes, you could do that. It really depends, again, on what other monies you have are. We should probably have a chat about that. So if you click the 15-minute schedule a call button, we can talk about your particular situation, Nate, and see if there's any way that we can help guide you through that. All right, I want to thank everybody for coming today to today's webinar. We used to be having these every Wednesday. Oh, we have a few more questions here. Let's see, Bob asked a question. There are some proposed income tax and estate tax changes from Biden. Was hoping you could add some insight on these proposals. Also, the state of California is proposing state income tax and estate tax changes. So yes, be happy to, Bob. So really quick, I know that the Biden camp is proposing eliminating the capital gains tax and instead going to just an ordinary income tax. So could that possibly hurt the market? It possibly could, but you have to understand also that by the time you take deductions and credits, sometimes your ordinary income tax rate could actually be better than capital gains tax rates. So I don't really know if that's going to change things that much moving forward. I know with the estate tax exemption right now being about 11.3, 11.4 million per person. So right now we're at about $24 million per person for estate tax exemption. I know there's talk of bringing that way down, and this is why if you have larger estates that exceed the $10 million limit or even the $6 million limit, we should probably have a conversation on the phone, because if we go back to pre-Trump, the estate tax exemption was $6 million on an estate for both couples, for both people. So if you own more than that in assets, that was then taxed at, I think it was 45%, anything over that 6 million. So that could be coming back. There's also been talk about California implementing its own estate tax, which could mean that they exempt themselves out of the federal tax, and on top of the federal tax that would be collected for estate tax, if it were eligible, your estate, they would also tax you in California on a much lower level of estate. So these are the things that we need to talk about in terms of strategy. So for us, again, it's not just trading and stock market strategy. It's about a lot of other things and formulating a whole legacy plan for a client, their beneficiaries, looking at the new Secure Act that came out late last year, which is now going to put your beneficiaries in a situation, if you own 401ks or IRAs, those must be distributed now 10 years after the IRA or 401k holder dies to a non-spouse. You have only 10 years to distribute that out, which could be a huge tax, especially those of you on this call who I know might have multi-million-dollar IRAs or qualified plans or pension plans. So again, these are the things that we have to talk about with you and talk through with you. So again, click that schedule a call button, 15 minutes, we'll talk it through, see if there might be a fit and if there's any way we can help you out. As I was mentioning before the Q&A, we are gonna go to more periodic webinars. We were doing these every Wednesday. The prep time that it takes for this was a huge amount. We're now up to number 20. This is number 20 this week that we've done since mid-March in terms of live webinars. Usually takes me about 6 to 7 hours of prep time per week. It's a lot. So we're going to back these down a bit, but we will be sending the emails out as to when we are going to have those. Let's see. We have a few more questions. John, let's see. With a Biden-controlled presidency, what will our investments look like? Again, I kind of went over that, John. It just really depends on what gets implemented and what doesn't get implemented. So I want to thank you all for attending today. Hope you have a great rest of today. Be safe. Tell your friends and family also about us. We'd love to have them on future webinars and be able to help them out with tax strategy if they are selling a building, selling a business, looking to retire, doing any of those things, or maybe they're just not happy with that financial relationship that they have currently. Thank you very much and have a great day. Bye-bye.